Welcome to Subramani. Please subscribe, please hit the bell icon. Many people have been asking me this question. The markets are very high. What should I do now? I agree with you that the markets are not exactly mouth-watering. And if the market falls, it could be eye-watering rather than mouth-watering. So it's not a great time that you want to invest, but you also don't know when the market is going to go down or when is it going to fall. Markets are normally volatile, but right now markets are not too volatile. Markets have been up, but the last 1 year returns in some of the shares could be bad. In some of the shares it could be, I think even in shares like TCS, last 5 year returns other than dividend is very close to zero. And this is not what you expected. Somebody told you, oh, you buy big shares, in 4-5 years it will double. Maybe the market is doubled, but some of your shares have not doubled. So this is bound to happen, and the market will fall, right? One day it will fall, one day it will go up. All those things will happen. How does one be an active investor, trader, and also manage the fluctuation? So first of all, understand it's a long game, right? You're in the markets for making money over 30, 40, 50 years, over generations, not over weeks. So if you are an investor and a trader, like people like me, I maybe 1% or 2% of my portfolio I trade. So even if my whatever I trade goes to zero, it's not going to kill me, right? I enjoy doing it, so I do it. But it's not a money making activity. It is more of matching my wit against the market. I do make money. I make enough money to meet my day-to-day expenses or much more than that from trading. So it's not, I'm not against trading, but understand life. Investment is the long-term game. So some shares like Colgate, I don't think in the last 15 years, 20 years I've touched it also, right? It is just there, it is growing, it is paying me dividends. Does it make sense? Yeah, I mean, HDFC Bank used to be like that, HDFC Limited used to be like that, which has also now become bank. So, but largely my portfolio, 98% plus, is in the long game. So that's one thing. So if you have to keep your portfolio, keep it in two places. Keep your trading portfolio and your investing portfolio separately, right? You can even have two demat accounts. Keep your investing portfolio in a HDFC Bank or an ICICI Bank, and your trading portfolio you keep it in a Way to Wealth or Zerodha or some place where you're trading, right? So do that. Secondly, as you grow older, diversification is essential. So some money will be in REIT, some money will be in debt fund, something will be in gold, or if you don't mind putting a part of your growth part in a multi-asset fund, because in a multi-asset fund, that's the only way how you can participate in gold in a big way, or you have to go and separately buy a gold fund. So I have done all of this. I have bought a share called Deccan Gold. I'm sure it will do well as gold as well. I have got a gold fund which has also got gold manufacturers fund. I think DSP has that fund, and DSP World Gold Fund. So I've invested there. I've also invested in a couple of multi-asset funds. Now my gold holding in the multi-asset fund is higher than the value of the other two, right? Simply because you keep putting more money into multi-asset, and say 10% of that, if I got 1 crore in multi-asset, 10 lakhs is already in gold, right? So you may not put that much in a gold fund, though I have money in Deccan Gold and in gold fund. So that's a way to diversify, because with Trump in US, the market fluctuation in the US and therefore the market fluctuation in India is bound to be there. Whether it is there, whether it falls, whether the SIP cash flows may dry up, I have no clue. I am not even guessing. Will the FIIs come and invest in India? I don't know. Maybe they'll invest somewhere else. I am not guessing any of those things. I am just saying diversification is a good thing to do, because whatever I diversify, I will be hugely there in equity, right? That does not go away. If I'm 90% in equity, it will only go to 89. It doesn't go below that. But at least the 10% should be able to meet your next 5 years expenses by the time market will bounce back. So rebalancing, diversification and rebalancing. If you think the equity markets are too high, taking some money and putting in gold makes sense. If you think gold is too high, taking some money from gold and putting it in silver may make sense. If you think gold and silver are high but copper is not high, it may make sense to buy copper. Not very easy unless you buy it through an ETF, right? Also, it is very important to turn down the noise, right? It is too noisy out there, whether it is mainstream media or social media or YouTube channels like this. Everybody is trying to tell you, if you don't invest in equity, you will be taken to the cleaners and say, oh, market is too high, you should sell, you should, people want you to act. Only if I tell you that, oh, today I think Larsen and Toubro is a good buy at this price, only then you will come back tomorrow to see what was my view on Larsen and Toubro. But if I tell you, just put money in an index fund and go to sleep, put money in a fund like HDFC Flexi Cap or iPro Discovery or Parag Parikh Flexi Cap, any of these things, it's a dull, boring advice. You just have found a good fund manager and you're just staying there, right? So then there is nothing to do, it's nothing exciting, it's pretty boring. So that means you have to turn down the noise, because the noise can come and say, oh, this month this flexi cap has done, XYZ flexi cap has done better than HDFC flexi cap and Parag Parikh flexi cap and blah 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 blah. You are saying, okay, I want to take a 30-year view on my fund, not a 3-month view. So turning down the noise is very, very important. And in case you bought some shares which have fallen in price, understand that when you're selling, you're just acknowledging the loss. The loss has already happened. You bought a share for 100 rupees, now it is 75, and you said, okay, when there's a 25% fall, I will sell. Then don't go and average, then sell, because that is the rule that you made for yourself. So make that rule and stick to that rule. And if you do make a loss today and that loss is visible to you on paper and you think that share is not worth buying or should not have been bought, it was a mistake, or you don't want to hold it now, circumstances have changed or whatever has happened, then sell, take your loss, right? Because if you earn 100 rupees profit and you make 20 rupees loss, you're going to pay tax on 80, right? It is a short-term capital gain and it is a short-term capital loss. Or if you have no short-term capital gain, but there is short-term capital gain available in your portfolio, sell that, book your losses, harvest your losses. So do some of these things, and this is the way you can keep calm when the whole market is losing its head. And largely money is made because you sat calmly when everybody was going around running like headless chicken. So yes, markets will change, markets will fluctuate, markets will fall. We have been saying this for a long time. Market has not fallen. It does not mean it will not fall, but when it falls, if you want to be protected, you have to do some of the you have to do ideally all the things which I just told you. Harvesting tax losses, of course, the last. Turning down the noise, rebalancing periodically, diversification, and understanding that it's a long game. When you do all these things, you will be able to handle your fluctuation in the market better than in a very unidimensional equity only portfolio. Thank you.